All right, let's talk more about earnings this season in the broader markets. Joining us now, Aoifinn Devitt, Moneta Chief Global Market Strategist and London CIV Chief Investment Officer. And Aoifinn, lately we have made the point that earnings might even be more important because perhaps we're not going to get the same number or timing on the Fed rate cuts. So earnings, the baton has kind of been passed. Maybe we keep the same multiple. That doesn't get, we don't see multiple expansion from a drop in rates. But things, a stronger economy can be good in its own right because earnings are good.
That's right. There's been a lot of focus on earnings, but primarily on how those earnings expectations are managed, which has been very well. And that's why I'd say we're seeing some of this reaction in some of the stocks today, like Uber that you just mentioned, strong numbers, but ultimately maybe that was already priced in. So good telegraphing going on. And yes, there is a focus on earnings, but let's not forget we're at 43% earnings in double digits increases. So really surprising on the upside. No earnings recession in evidence. We're seeing inflation come down. We're seeing companies retain pricing power. Every company is talking about the resilience of the consumer, especially around discretionary issues. So what's not to like, essentially, around the earnings picture right now?
Aoifinn, is there an actual demonstrable linkage between a strong economy and inflation, strong labor and inflation, or can we actually have a strong economy and continue to see inflation moderate, which it would almost be too good to be true? Is that a pipe dream, or is that actually what we're seeing?
It doesn't fit with the economic models, but it does. This is an extraordinary economy that's not fitting with much precedent or with models. Of course, how much do wage increases contribute to inflation? If we look back at what's contributing to inflation right now, and remember it's very much receding, it is the service sectors, things like insurance, things like shelter. It's not generally the cost of labor. The cost of labor is up slightly, but it has been a lagging indicator and has been trailing. I would suggest we're getting close to the end of some of that frothiness around labor. We're definitely seeing softer indicators around the economy, less of the great resignation. And we're seeing more of these layoffs that's going to take hold. It is a lagging indicator, as I said. So the good thing about the employment market is it's stable. It's keeping the consumer in jobs and stable and spending. But I do think we can see recession continuing to fall, inflation continuing to fall as the jobs number stays solid.
So the pandemic-related stimulus that was going to run out and eventually show up with consumers that that weren't going to be able to keep consuming. Did that not happen, or did once again another baton? The strong labor market is actually giving consumers a second wind, or there's no reason to think that at the end of all the support that we saw during the pandemic, that's not something we need to deal with. That was we shouldn't have been worried about that all along.
Well, the support is going to has run out, but remember it's still in money market funds. So over $6 trillion in money market funds today, an all-time high. So that's sitting there, or it's already been spent, and we're seeing the fruit of that in some of these earnings that we're hearing about now. There's a lot of money there. The stimulus, perhaps, though, is not going to be there in excess, certainly not in terms of handouts. And we can see with the Fed, why should it lower rates at this point unless it has a compelling need? Because we can see the perils of overshooting in that respect. So I'd say we're not worrying so much about stimulus. That's still there and ready to be spent. But on the labor side, what that does is take some of the uncertainty, some of the worry out of the consumer. Although, as we can still see, sentiment is still fairly depressed. It doesn't reflect the economic numbers we're seeing. We've heard about a vibe session. And why is that? Probably because of the cumulative effect of the high inflation. We're still, with the exception of gas prices, which are lower, we're still looking at a much higher grocery basket. And that's still continuing to sting. That's why the sentiment is depressed.
Well, tell me about the sentiment. Do people think 2024 is going to be a good year, as election years are, more often than not, for the stock market? Last year, you could cut the negativity with a knife, right, from all through the first quarter, probably the second quarter, and now we know what happened. Seems different this year. It's certainly not as negative. Do we need a wall of worry to climb, or can we continue to sort of just drift higher?
Certain political narratives certainly benefit from a wall of worry. I'd say that right now there's still a little bit of uncertainty in terms of the actual political landscape. It's certainly every day that is cleaning up that uncertainty. Once the election gets into full swing, we're going to have rhetoric that is charged on either side, and that's likely to lead to perhaps to sparking some uncertainty. But overall, there does tend to be a strong market in election years, especially once the uncertainty of which candidate is likely to prevail has been removed. I don't think that uncertainty will be removed till right to the end, but there's going to be definitely a strong rally after that. So, of course, remember, it's on both parties benefit to really to drum things up and to not have a recession of any kind. So I think that all bodes well in terms of the incentives, and much of the economy is about incentives.
And how many rate cuts and when do we get the first one? And does it matter?
It definitely matters, because that's going to be a sign that the Fed has seen reason to cut. So they've either been assured around inflation that it's in the rearview mirror, that they've achieved their targets, their data is right, or there's been a negative surprise like we saw with the regional banks, and it's not just a pause, but it's a cut that we get. So it will be momentous whenever it comes. I'd say we're not looking at the first half. I think we can already see expectations have come down significantly around that. I'd be looking at the second half of the year, 1 or 2, but again, very data dependent. And I think we have to be quite satisfied with the economy as it is, ticking along without needing that rate cut.
It's really unbelievable. The number of people that were sure that we would have had at least a slowdown by now, and it's just nowhere to be seen. Aoifinn, thank you.